Hello financial fans, welcome back to another stock analysis. Today we'll be covering Domino's Pizza stock ticker DPZ. Domino's is a global pizza delivery and takeout chain renowned for its quick and convenient service. With a widespread presence, Domino's specializes in offering an extensive selection of pizzas with various toppings and flavors to cater to diverse tastes. Emphasizing efficiency and customer satisfaction, they prioritize fast delivery, user-friendly ordering, platforms, and commitment to ensuring an enjoyable dining experience for all. The company is currently sitting at a market cap of $13.6 billion, and in 2022 they generated a revenue of $4.54 billion, and the dividend yield is currently sitting at 1.26%. 59% of their revenue comes from supply chain, 12% from US franchise, 11% from US advertising, 11% from US company owned, and 7% from international franchise. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25%. That can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we'll look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. I'll be using 4 colors in a scale. Bright red will mean a 5% increase, orange will mean no change, light green with a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean 5% increase, orange will mean no change, and bright green will mean a 5% deduction. First metrics that we'll be looking at are the EBIT growth and the margin growth. EBIT has gone up over the years, going from $314 million to $772 million in 2022. The average EBIT growth during this period is 10.6%, which is no change in the margin of safety. The margin has gone down over the years, going from 17.4% in 2013 to 17% in 2022. The average decline during this period in their margin is 0.15%, which is no change in the margin of safety. The next two ratios that we'll be using are the dividend growth and the payout ratio. The dividend has gone up over the years, going from 80 cents a share in 2013 to $4.84 a share in 2023. The average dividend growth during this period is almost 20%, which is a 10% deduction in the margin of safety. This with a payout ratio that's sitting at almost 35%, which is no change in the margin of safety on this metric. The final two metrics that we'll be using are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, you have to take the company's debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Domino's, this is just over 6 years, which is a 630% debt to EBITDA ratio, which is incredibly high. This gives them a 5% increase in the margin of safety on this metric. The return on invested capital, however, is sitting very nicely at a 49.4% ratio, indicating that the management is very effective at allocating capital, which awards them with a 5% deduction in a margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Domino's. The first model that we'll be using is the discounted cash flow model. I've imported free cash flow of Domino's, going from 2013 to 2022. The average growth rate in their free cash flow annually during this period was almost 21%, and I'm projecting an expected growth rate in their future free cash flow of 15% annually for the next 10 years. With this percentage, we'll determine the future free cash flow for Domino's and determine a terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 9%. This gives them a sum of free cash flow of $16 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of almost $11 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $306.94, which is a 20.20% downside from the current price. The second model that we'll be using is the dividend discount model. I've imported dividend payouts of Domino's come from 4 years ago to the current year. The growth rate during this period in their dividends was almost 17%, and I'm projecting an expected growth rate in all of their future dividends of 8%. And we'll once again be using a discount rate of 9% in this valuation, giving them a discounted dividend model price per share of $522.72, which is almost a 36% upside from the current price. The next model that we'll be using is Graham's revised valuation formula. This model will take a look at the earnings per share that Domino's is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. Looking at all of these metrics, we get a fair value of $220.32, which is almost a 43% downside from this model. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Domino's, look at the stock price and the earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 32.84. Also have to do to get a fair value out of this model then, is to multiply by the earnings per share the Domino's Pizza is generating, which is $12.96 a share, giving us a fair value of $425.57, which is a 10.6% upside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of the past 5 years. On an average, it has been sitting at 0.88%, while the current yield is sitting at 1.26%, indicating that it's currently undervalued on this metric. Doing the same with the PE ratio, on average of the past 5 years, it has been sitting at 32.25. While the current PE ratio is 29.68, indicating that it's once again slightly undervalued on this metric, giving us a fair value of $485.62, which is a 26.25% upside of this model. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at our final overview, we've imported discounted cash flow, discount dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $392.23. A margin of safety we've determined earlier, using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, deducting by 5% for the return on invested capital, and deducting it by 10% for the dividend growth, leaving us with a margin of safety of 15%. Applying this margin of safety, we get a fair value of $333.40, and with the current price of $384.66, we get a downside of 13%, indicating that it's currently a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.